This YTM will be used as cost of debt pre-tax. Because we have seen in detail that the debt saves the tax bill. If you have debt, you will have interest. If you will have interest, you will pay this before the tax payment. Therefore, with each and every interest payment, your taxable income reduces. If your taxable income reduces, obviously your tax bill reduces. Your tax liability decreases. So, once a company having debt, a company not having debt. The company having debt will pay interest. The interest will be charged before the tax payment. Therefore, the taxable income reduces. Based on the reduced taxable income, less tax is paid by the company. That is why debt is known as tax saving instrument or tax shield instrument. How to calculate the tax shield? The interest multiplied by the tax rate will be the tax shield the company saved in the tax budget, a tax bill. Therefore, each and every debt reduces the tax liability. And that's why known as the tax saving instrument or tax shield instrument. Now, if it is saving tax, definitely we will calculate before tax and after tax. The YTM is before tax. YTM multiplied by 1 minus tax will be the after tax. So whatever YTM you got, for example, your YTM is 5%. That means the before tax cost of debt is 5%. If you are in the 40% tax bracket, then your after tax cost of debt will be 5% multiplied by 1 minus 40%, 1 minus tax is equal to 5% multiplied by 1 minus tax is equal to tax is 40%. So 5% multiplied by 60% is equal to 3%. So pre-tax cost of debt is 5%. Post-tax cost of debt is 3%. So always you calculate the pre-tax and post-tax cost of debt. Hope it is clear. Now we will go to the third type of security or the third type of financing instrument of a company is preferred stock. And preferred stock also gets fixed amount of dividend. Therefore, it is too straightforward while calculating the cost of preferred. How we calculate the cost of preferred? Very simple. Dividend divided by the price of the preferred or present value of the preferred. Price of the preferred is equal to cost of preferred. It is too straightforward. For example, if preferred stock pays $2 dividend, it is traded at 100. What is the cost of the preferred? The formula is dividend divided by price. $2 divided by 100 is equal to 2% will be the cost of preferred. Now question is, we have calculated cost of equity. We have calculated cost of debt pre and post. For example, 5% is cost of debt pre. If 40% is the tax rate, then post-tax cost of debt is equal to 5% multiplied by 1 minus 40% is equal to 3%. Then we calculated the cost of preferred. After doing that, the last step is calculating the WACC, weighted average cost of capital. Here, the weighted average cost of capital is calculated by the formula. Normally, companies don't issue preferred. It's not very popular. That's why the author has used here only equity and debt. He assumed that the company is having equity and debt. If preferred is there, you can add preferred, no issue. So, weight of equity multiplied by cost of equity plus weight of debt multiplied by cost of debt multiplied by 1 minus tax. Then only post-tax cost of debt will be taken. So again formula, weight of equity multiplied by cost of equity. Cost of equity, no post, no pre, all same. So weight of equity multiplied by cost of equity plus weight of debt multiplied by cost of debt multiplied by 1 minus tax. Here question is how we calculate the weight of equity. Very simple. The equity divided by market value of equity divided by the equity plus debt. How we calculate the weight of debt? Simple. The debt divided by equity plus debt. For example, if a company has 100 million of capital structure, if a company has 100 million of capital structure, 60 million is equity, 40 million is debt, then weight of equity is equal to 60 divided by 100, that is equal to 60%. Weight of debt will be 40 divided by 100. How it is 100? 60 equity, 40 debt, total asset or total capital is 100. Equity capital is 60, therefore 60 divided by 100 is 60% weight of equity. 40 divided by 100 is 40% for weight of debt. Now weight of debt multiplied by cost of debt 1 minus tax. In the previous example we have taken cost of debt as 5%, tax is 40%. So 5% multiplied by 1 minus 40% is equal to 3%. Cost of equity, for example, 10%. Then how we calculate the work? 60% multiplied by 10%. 60% multiplied by 10% plus 40% multiplied by 3%. So 60% of 10% is equal to 6%. 40% of 3% is equal to 1.2%. So 6 plus 1.2 is equal to 7.2% will be the work. If you want to write down this example, you can write down also. Here, for example, we can say if, for example, we have 10% is cost of equity, the R equity is equal to 10% and R debt is equal to 5%. This is pre-tax. Similarly, the tax structure is equal to 40%. The debt is 40 million. That is $40 million. And equity is equal to $60 million. Debt is 40 million, equity is 60 million. So total asset is equal to 100 million. Okay, now the R work is equal to 60 divided by 60 plus 40 whole multiplied with 10% plus 40 divided by 60 plus 40 multiplied by 5% multiplied by 1 minus tax. 1 minus 40% is equal to this is equal to 6%, this is equal to 1.2 is equal to 6% plus 1.2% is equal to 7.2%. This is the way we calculate the work. So next is, once we calculate the firm valuation, when we are using the DDM, dividend discount model, there we use the cost of equity as the for discounting the future cash flows to present. But when you are making the firm valuation, then you use the free cash flow, and for the free cash flow you use the WACC instead of cost of equity. And we discussed how WACC is calculated. To find equity value, what you do? From the total value of firm, deduct the debt, it will be the equity value. Divide by the number of shares, it will be the per share value. We estimate the cost of equity for international paper, then we will calculate the cost of debt, and after that we will calculate the WACC the same way we have done in the previous slide. And once we calculate the WACC, that will be used for the firm valuation. Industry beta is 0.82, which we will use as the proxy for this company. Risk-free rate is 2%. Market risk premium is 7%. Calculate the cost of equity using the CAPM. Risk-free rate of return 2% plus 0.82 multiplied by 7% is equal to 7% will be the 7.74% will be the cost of equity. All right, I think it is clear to everyone. For international paper, the cost of equity will be 7.74%. Now, cost of debt. The YTM of the existing company's debt is 5%. As we have taken 5%, normally the debt cost remains before tax 5-6%. So here the international paper company, the cost of debt for existing debt is 5%. That is the YTM. And the firm is in the 21% tax bracket. Therefore, post-tax cost of debt will be 5%, 1 minus 21% is equal to and debt to value ratio is 32%. Therefore, debt 32% means the equity will be, weight of debt is 32%. Therefore, weight of equity will be how much? 100 minus 32 is equal to 68%. Use the formula, put the formula and get the answer. How? The weight of debt is 32%. So, the weight of equity will be 68%. 68% multiplied by 7.78% cost of equity plus 32% multiplied by 5% multiplied by 1 minus 21% is equal to 6.53 will be the WACC, which will be used for valuation of international papers, cash flows and valuation of the firm. This is the international international papers cost of capital or overall cost of capital or WACC is 6.53%. It should be used for discounting any project where one believes that the project risk is equal to the risk of the firm as a whole and project has the same leverage as the firm as a whole. Now we see the last part of this chapter, that is flotation cost. You know, whether it is whether it is debt or it is equity, whatever security you issue, there will be some flotation cost or issue cost. Okay, so those like fees, like advertisement cost, all these things will be the cost for issuance of the particular security. So each kind of security, whether debt or equity, the issuance cost will be there. And for equity, the issuance cost is more comparing to the debt. or bonds. Now, how the issuance cost will be adjusted while calculating NPV? In the previous chapters also we have seen this same thing. So when we are calculating the NPV for a project, first of all we adjust the amount raised with the flotation cost. How we do that? Whatever money you received, for example, you issued 100 millions of equity. You issued 100 millions of equity. For example, you issued at 10% premium. That means you have got 110 million. The flotation costs are 12%. The flotation costs are 12%, means that for issuing the equity, you have spent 12 million at the beginning as the issuance cost. Then what will be the net amount raised? Net amount raised is equal to 100 million the face value, 10 million you issued at premium is equal to 110 million. That is the amount you got in your bank divided by 1 minus flotation cost. Your flotation cost is 12%. So 1 minus 12% is equal to 88%. So that will be your net proceeds, that is equal to 125 million. So whatever you have received actually 125 million. 25 million you have spent for the flotation. Therefore, 120 million came to your hand as the net amount. This is the way we calculate the flotation cost is being adjusted while calculating the NPV. You know, don't take this flotation cost as an expenses in the project. No. Whatever the amount you are receiving from the issue of the equity or debt, you adjust with the net amount, whatever net amount, because you see, if you are issuing 100 million at 20% premium or 10% premium, whatever you are issuing, that amount you are not getting completely. Out of that, here in this case, what happened? You issued the security at 25% premium. So you got 125 million. 15 million you spent on flotation cost. Therefore, in your hand, 110 million remains. That's why the amount raised is equal to 110 million, what is there in your hand now, divided by 1 minus flotation cost. So you issued 100 million worth of security at 25% premium. You got 125 million. From the 125 million, 12% is your flotation cost. So 15 million has gone. So in your hand, net is necessary proceed in your hand is 110 million. So you should not ignore. If you are getting 125, it comes to your hand is 110. So this you adjust at the same place and make the project cost will be not 110 million, it will be 125 million. Then how the flotation cost of the total, this is for the equity. Then same for debt also. When you are getting the money net proceed, it is equal to, the gross proceed is equal to net proceed divided by 1 minus flotation cost. Therefore, the flotation cost of the asset is equal to the stock divided by the value multiplied by the flotation cost of stock plus the bond proceeds from the bond divided by the value multiplied by the flotation cost of the bond will give you the flotation cost of the total assets. I hope this is clear, and any question, just let me know.